Hello, and welcome back to Reflections on Investing with the Cornell Capital Group. You know, I often hear that investing has changed. The stock market is different now. The web has changed it. Technology has changed it. New types of traders have changed it. This is all poppycock. Investing hasn't changed, and it won't change. At its core, it's very basic. You give up money now, and you hope to get enough back at some time in the future to justify the risks you take and the deferral, the time value of your money. And that's all there is to investing. In this context, all companies make the same thing, whether they're brick and mortar retailers, high-tech electric vehicle makers like Tesla, or old oil companies like Exxon. They all make the same thing. They make money. And that money allows them to pay you those payouts in the future that you're waiting for when you put your money up today. Well, why does it matter what the company does? Why does it matter whether it's Tesla or Exxon? The reason it matters is the business the company's in, the technology it has, the quality of its management. All those influence how much money the company can make in the future, and therefore how much it'll be able to pay out to you, the stockholders. So in this context, all you're doing when you're investing is putting your money up today, looking at and evaluating the company, and trying to predict how much it's going to be able to pay out to you in the future. But there's a wrinkle. And this wrinkle is what involves all the mischief. The wrinkle is that rather than investing today with the goal of getting those payouts in the future from the company, you invest today with the goal of selling to someone else tomorrow or in the near future at a higher price. And you really don't care what the company's going to do 5 or 10 years from now, except to the extent that the person to whom you're selling is willing to pay more than you paid because he or she believes those future payouts are greater. But maybe the person that you're selling to believes that they can buy it from you at a higher price and then sell it to someone else after that at a yet higher price, who will in turn sell it to someone else at a yet higher price, and so on. And these sort of loops, these momentum loops where everyone is hoping to sell to someone else at a higher price, are the foundation of a bubble. And this type of bubble can go on for substantial periods. In fact, we have an index at the Cornell Capital Group, the unprofitable index. And if you look at it, it should be on the screen now. If you look at it, you can see that from January 1, 2020 until the current date, the S&P 500 has risen about 33%. Sounds like a pretty good return. But the unprofitable index, which consists of companies that have not made a penny yet in their entire lifetime, has risen 249% over the same time. That's pretty amazing. And that means that if you think of it in the traditional investing sense, people must believe that these companies are not only going to start to make money, they're going to make enough far enough down the road to justify these super high prices that are being paid for it. That's pretty hard to believe. That doesn't seem reasonable. It seems far more likely that there are people who are buying the unprofitables are buying them because they're hot, sexy technology companies, and they believe they'll be able to sell them to someone else for more in the near future. Well, what happens here? What's the risk of all this? Well, the problem is that eventually the prices get so high relative to revenues or earnings, or in the case of the unprofitables, it must be revenue because there are no earnings, that there is no later buyer. There's no one willing to come along later and pay more. And when you reach that point, then people who bought the stock because they thought they'd be able to sell to someone else for more decide it's time to sell. But to whom? There aren't any people who believe it's going to be higher in the future because they can sell to someone else. And the prices run up so much relative to the revenues or earnings that fundamental investors won't buy. And at this point, the price collapses. Now, the point of all this is to say there's nothing new in all of this. John Maynard Keynes complained about this aspect of stock markets. In fact, even Isaac Newton complained about it. But the fact is, it looks like it is alive and well today, and it is a fundamental risk of investing in today's markets, particularly for the type of companies that are in the unprofitable index. This has been Reflections on Investing.